Mortgages are loans, and bonds are essentially loans to the government or whatever entity that you're working with. Go to buy a government bond and I want to, let's say I'm going to pay $1,000. It's a 10-year term and they're going to pay me 5%. I'm essentially giving the government a loan of $1,000 in exchange for being paid a certain interest rate. And at the end of the 10-year period, I get my money back in full and I'm no longer entitled to the interest. So that's the same thing when you take out a mortgage, right? The bank pays you in full upfront so you can purchase the property in exchange for you paying them annual interest every year or every month. And when your 30-year term is over or when you decide to sell, they have now been repaid in full and they are no longer entitled to your interest payments. Now, when you close escrow, whomever issued your mortgage is likely going to turn it into a bond and go and sell it on the open market. Well, they basically take a pool of mortgages, right? They're going to take my mortgage, your mortgage, the guy down the street's mortgage, right? And they're going to wrap it up into what's called a mortgage-backed security. Security is just a fancy name for any product that you can trade. So stocks are a security, bonds are a security, Bitcoin is a type of security, right? So these are called mortgage-backed securities. So they pool the loans. There's, maybe there's a 7% mortgage in there. There's a 5.5% mortgage in there. So whatever it is, it'll be an average, call it 6.25%. Now they're selling off this bond that's going to pay someone 6.25% a year.